On January 29, 2026, Panama's Supreme Court delivered a ruling that stunned global markets by canceling a 30-year agreement with Hong Kong's CK Hutchison Holdings, the operator responsible for the Balboa and Cristobal ports at the Panama Canal since the late 1990s. The decision immediately triggered shock across global shipping, trade, and investment circles, raising serious concerns about the stability of one of the world's most important maritime choke points. For nearly 3 decades, this arrangement had supported global commerce by ensuring stable and predictable operations at the canal, which links the Pacific and Atlantic Oceans and handles millions of shipping containers every year. The system had long been essential for international supply chains, allowing goods to move efficiently across continents with minimal disruption. However, less than a month after the court's ruling, Panama's government escalated the situation dramatically. In a highly controversial move, authorities took direct control of the ports, removed Chinese-linked management teams, and seized billions of dollars in port infrastructure and assets. The takeover was sudden and executed with little warning, leaving workers, investors, and international observers completely surprised. The reaction was immediate. Global markets responded sharply, with shipping and logistics stocks falling as uncertainty spread. Confidence in Panama's canal operations, built over a century, weakened almost overnight, replaced by fears of political interference and operational instability. Around $4 billion in Chinese-linked investments suddenly became vulnerable, along with numerous infrastructure agreements and future development projects. Investors began reassessing risk in other strategic regions, worried that similar government actions could occur elsewhere. This shift led to a rise in perceived risk for major infrastructure investments worldwide, increasing insurance costs and forcing some shipping companies to reroute vessels to avoid potential disruptions. As delays and bottlenecks increased, pressure mounted on already fragile global logistics networks. What had long been viewed as a stable and neutral trade route was now at the center of geopolitical tension. The crisis did not emerge in isolation. It developed after months of rising political friction involving global powers competing for influence in Latin America. The United States, increasingly concerned about China's growing presence in the region, intensified diplomatic and strategic efforts to limit Beijing's influence, especially around the Panama Canal, which remains vital for global trade and U.S. security interests. When a new U.S. administration returned to power, it placed renewed emphasis on the canal, framing it as a strategic asset tied to American influence. Public debate even revived discussions about greater U.S. control, echoing Cold War-era rhetoric. Panama initially resisted this pressure, trying to maintain its independent position while balancing relationships with both Washington and Beijing. However, sustained diplomatic pressure, economic incentives, and security assurances from the United States made this balancing act increasingly difficult. In early 2025, Panama made a major foreign policy shift by withdrawing from China's Belt and Road Initiative, signaling alignment with Washington. Shortly afterward, Panama's Supreme Court issued the ruling that voided the CK Hutchison contract, a decision widely interpreted by observers as influenced by geopolitical pressure. The outcome was publicly framed as a legal matter, but many analysts viewed it as part of broader strategic maneuvering. U.S. officials welcomed the development, describing it as a major diplomatic success. Ultimately, Panama's position between competing global powers placed its sovereignty under intense strain. Despite efforts to maintain independence, external influence reshaped key national decisions, signaling a significant shift in the country's geopolitical alignment. China responded quickly and forcefully to Panama's actions, escalating the dispute into a broader economic and legal confrontation. Within days, Beijing made its position clear, signaling that the seizure of the ports would carry significant consequences on multiple fronts. CK Hutchison Holdings immediately launched a $2 billion international arbitration case, escalating the conflict into the global legal arena. At the same time, economic retaliation began to unfold. One of the most significant moves came from COSCO Shipping, the canal's second-largest user, which abruptly suspended operations at the Balboa port. This alone resulted in an estimated $800,000 in daily revenue losses for Panama and sent shockwaves through the shipping sector. China expanded its response by freezing more than $5 billion in planned infrastructure investments across Panama. Construction projects across the country stalled, leaving unfinished developments and causing widespread job losses. Chinese companies began withdrawing rapidly, pulling capital and shutting down operations, triggering a wave of capital flight that destabilized Panama's financial system. Further pressure came through trade restrictions. China imposed strict inspections and delays on Panamanian exports, particularly agricultural goods, causing significant losses for exporters and farmers as shipments sat stranded in ports and warehouses. The message from Beijing was clear: Panama would face serious consequences for its actions. This multi-layered retaliation combined legal action, trade disruption, investment freezes, and corporate withdrawal. The result was a rapid breakdown of what had once been a strong economic partnership. Panama's credit rating was downgraded, increasing borrowing costs and straining public finances. Foreign investment collapsed, with nearly 80% of planned projects being canceled, not only by Chinese firms, but also by global investors concerned about rising political risk. Thousands of jobs were lost, and billions in revenue disappeared from the economy. The pending $2 billion arbitration case added further uncertainty. Looking back, Panama had once benefited significantly from close ties with China. After switching diplomatic recognition from Taiwan to China in 2017, the country experienced a surge in investment and trade growth. China became one of the canal's most important users, and major infrastructure upgrades were funded by billions in Chinese capital. However, as geopolitical competition between major powers intensified, maintaining neutrality became increasingly difficult. Panama's attempt to balance relations with both the United States and China ultimately unraveled, exposing the vulnerability of smaller nations caught between global superpowers. In response to the crisis, global shipping routes began shifting. Chinese-linked operators and other international firms started exploring alternative logistics hubs. One major development was the growing attention on Peru's Chancay port, a large Chinese-backed project designed to handle massive shipping volumes and bypass traditional canal routes entirely. This shift signaled a broader transformation in global trade patterns. As geopolitical tensions increased, countries and corporations began prioritizing route security and political stability over traditional geographic efficiency. The global logistics system started evolving toward a more fragmented, multipolar structure. The financial impact of Panama's crisis quickly spread beyond Latin America, shaking global markets. Within hours of China's withdrawal and escalating tensions, stock markets around the world reacted sharply. Major indexes in Asia and the Americas declined as investors rushed to reassess exposure to geopolitical risk. Shipping companies, logistics firms, and regional banks were among the first to be hit, but the ripple effects extended much further. Insurance costs for canal transit surged, and concerns over supply chain disruption spread rapidly across industries. Even sectors such as technology and manufacturing began to feel the indirect pressure. As uncertainty grew, investors moved toward traditional safe haven assets. Gold prices rose along with U.S. Treasury bonds, while emerging market currencies came under heavy pressure. Hedge funds rapidly repositioned portfolios, preparing for prolonged volatility and shifting global trade dynamics. Analysts emphasized that the crisis was not just a regional disruption, but a global economic shock. The estimated $4 billion exposure tied to Panama's situation was distributed across multiple sectors. Shipping and logistics companies faced the largest direct impact, with around $1.2 billion in contracts and toll revenues disrupted. Panama's government and canal authority faced nearly $900 million in lost income and delayed infrastructure funding. Construction and engineering firms lost approximately $700 million due to halted projects. Banks and insurance companies were exposed to roughly $600 million in risky loans and coverage linked to canal operations, while global importers and exporters faced another $600 million in increased shipping costs and delays. Supply chains built around just-in-time delivery systems were suddenly under strain. Across Latin America, neighboring countries reacted quickly. Governments in Mexico, Colombia, Costa Rica, Brazil, and Chile began reassessing trade strategies and port infrastructure investments. Some sought to redirect shipping routes, while others engaged in emergency diplomatic discussions to protect regional trade stability. The Organization of American States also called for urgent coordination to prevent wider economic fallout. Meanwhile, global shipping networks entered a period of major disruption. Cargo vessels were forced to take longer routes around South America, significantly increasing transit times and operational costs. Congestion increased at alternative ports, while insurance premiums rose due to heightened geopolitical and logistical risk. Freight prices surged dramatically, in some cases increasing by up to 300%. Smaller exporters struggled to absorb rising costs, forcing some out of key international markets. Delays affected everything from food supplies to electronics and automotive production, creating pressure across global supply chains. At the same time, the crisis intensified the strategic rivalry between the United States and China. Both powers expanded their influence efforts across Latin America, turning infrastructure and trade routes into tools of geopolitical competition. Smaller nations found themselves increasingly pressured to align with one side or the other. Experts warned that Panama's situation may represent a turning point in global trade governance, where political considerations now carry as much weight as geography. The stability of traditional shipping routes is no longer guaranteed, and new alternative corridors are rapidly emerging. As the situation stabilized slightly, attention turned to the future of the Panama Canal itself. Questions remain over whether it can regain investor confidence, secure new funding, and maintain its relevance in a rapidly changing global logistics system. Some see a path forward through diversified international partnerships, while others fear continued instability could permanently weaken its role. What remains clear is that the Panama Canal, once considered an unshakable pillar of global trade, is now at the center of a shifting geopolitical and economic landscape whose long-term consequences are only beginning to unfold.